Okay. So a firm has no capital rationing. That means they don't have any deficiency of funds, it seems. Constraint, they have mentioned constraint is nothing but bottleneck resource. Something in deficiency is constraint. Okay. Firm has no capital rationing constraint and is analyzing many independent investment alternatives. The firm should accept all investment proposals, but on what basis? That have positive cash flows, that have positive NPV, that provides returns greater than the before tax cost of debt. It's if debt financing is available for them. What is your answer? So we are doing investment decisions and we already know that any project which is giving you positive NPV is always acceptable, right? So all the
Yes.
projects which are giving positive NPV is always acceptable. One. What about this? So positive cash flows, see, if you get positive cash flows, that is like, uh, like an investment with positive cash flows may be bad also at times due to time value of money. Cash flows in later years are not as valuable as in the earlier years. That means what we have today or what we are getting today is more important than tomorrow, right?
Yes.
Correct or wrong?
Yes,
So
sir.
like investment with positive cash flows can also be a bad investment due to the time value of money concept, because cash flow in later years are not valuable for you, correct,
Yes.
than
Oh,
today. Positive NPV projects can any time be taken. So a company should always accept investment proposal unless some are mutually exclusive. So when it comes to mutually exclusive projects, what do you mean by mutually exclusive? You can select only one out of many, right?
yes.
So a company should accept any investment proposal, any, either 1, 2, 5, whatever, unless they are mutually exclusive. In mutually exclusive, the condition, the precondition is only one you should select. That has
Yes.
positive NPV or IRR greater than company's desired rate of return. That means IRR more than cost of capital. So you can select it. But in mutual exclusive, you have to select only one. Okay. So
Okay.
now the third option, that provides return greater than before tax cost of debt. Returns can should always exceed desired rate of return. So like before tax cost of debt, it doesn't mean that it is your desired return, right? Always, correct? And what is this? It's strange, like debt financing, if it is available, it is not the reason to decide about the project. I'm getting a loan. So if I want to buy an apartment in any other area whereby it's available for 2 crores or 5 crores, bank is ready to give me, but I should also have the capacity to pay, right? So
Yeah.
if I'm getting easy loans, that doesn't mean I can take up any project. That's not the criteria. Next question. The recommended technique for evaluating projects when capital is rationed. See, already I have given the videos in that very clearly things are mentioned, right? So,
Yeah.
and there are no mutually exclusive projects from which to choose is to rank the projects by. See, you are evaluating some projects. There's a capital rationing and there are no mutual exclusive projects from which to rank is to rank the projects by what, on what basis. So I can say profitability index, right? Hello.
Yes, sir. Hello.
Yeah, see, if it is, if at all you are evaluating certain projects, the recommended technique for evaluating projects when there is capital rationing. In case of capital rationing, already you had a question also. One question was there, right? Whereby profitability index and NPV2 were considered and profitability index we were considering. So when there is capital rationing, okay. So first of all, what is profitability index? Profitability index is nothing but the present value of cash inflows by present value of cash outflows. Correct?
It's an initial investment, sir, denominator.
Yeah, that's what it's present value of cash
Oh,
outflow is nothing but
oh,
initial investment, right?
right.
And if at all my inflow is 1 lakh 20,000 and my outflow is 1 lakh, I'm getting a profitability index of 1.2. That is more than 1. So any project which gives you PI more than 1 can be accepted, right?
Accepted. Yes.
So I've explained you right now. The profitability index is a variation of NPV method and facilitates comparison of different sized projects. So it is what actually variation of NPV method, and it facilitates comparison of different sized investments. That means if you know the investments are of different size, then what happens, profitability index can be taken for evaluating those investments or selecting any one of them out of the available projects, right?
Yeah.
So as I have clearly mentioned you, what the recommended technique for evaluating projects when there is a capital rationing, that means you have deficiency of capital, or there are two types of capital rationing, hard and soft, so you know that, and there are no mutually exclusive projects. Then if you want to rank, you can rank with the help of PI. Okay, the highest PI one you can select. Understood now?
Yes, sir.
Yeah. And next, payback cannot be the criteria for selecting the project because it has lot many flaws. Okay, it ignores time value of money also, and ARR doesn't consider the cash flows at all. It is not a, it's a poor technique actually, and it also ignores TVM. Ignores TVM, ignores TVM. So like here we are taking up the projects which like we are going to expect cash flows in the future, and if we ignore TVM, if we don't take time value of money, then we are not adjusting the future cash flows with many with inflation or other aspects. So then do you think these two are going to give you a satisfactory answer? Never. Next question, Samrit, next question. If you read, we'll do the next question. So Capital Invest Inc. uses a 12% hurdle rate. That is their required minimum required rate of return for all expenditures, and has done the following analysis for 4 projects for the upcoming year. Okay, so just read this, and we'll see. We just try to answer. So always you should be understanding hurdle rate is minimum returns. Okay, minimum returns required by a company's management or investor from a project in which they are investing. So minimum returns from investment. And then the initial cash outlay or capital outlays are given, and you're expecting all these cash flows, and there is NPV and there is profitability index also given. So you know this is not good. This is giving negative NPV as well, not at all acceptable. And these projects look good because positive NPVs are there and also PI is more than 1, right? But let us see what is the question. And IRRs are also given to you. And you know we only accept the projects whose IRR is more than the cost of capital. So these 3 seem to be correct. Is it
Yes.
clear to you, Samrin? Everything?
Sir.
Hello?
Yes, sir. Hello.
Yeah. So is it clear? The question is clear?
Sir, clear.
Shall we move forward? Yes. So they are asking which project should Capital Invest undertake during the upcoming year if it has only 300,000 of capital funds. So they are speaking about capital rationing.
Okay.
They have only this much funds.
Hello.
Yeah, yeah. Hello, hello. Yes, yes, yes.
Yes, screen. Yeah.
So first of all, they have 300,000, right? Yes.
Yes.
So if they have only 300,000, so projects 3 and 4, can they take up? First of all, they have only this much funds, and the outlay which is required for project 1 and 2 is more than 3 lakhs, right? Combined. Here, if
Yeah.
they put 2 lakh here, and like nothing has been mentioned here. Like they have capital rationing, that is understood fact. In the sense that statement is not there, but they have this much funds available, they're saying.
Mm.
So they can, like the demand is only one project can be taken at a time in all the four cases, correct? Either they can take this, either they can take this, either they can take this, either they can take this. Why? Because they have $300,000, correct? So
Yeah.
if they take up this one, they cannot take this combined, right?
Yeah.
Because see, I'm saying if they put 200,000 in this, they are left over with 100,000. If they put into this, that has the investment is not satisfactory, right? Because the
Yes.
demand is for extra 198. So
Right.
only extra 100,000 in this will not suffice or will not solve the purpose. So they cannot take any two projects at all. So we will just remove all these options. They cannot take this two, they cannot take this two because they have limitation. They can only spend 300,000. That is the limit. So if they spend the entire money also in the next project, they cannot completely fund it, right? Then
Yeah.
we will take project one. So if I take project one, the criteria is not suiting because it is giving negative NPV and the PI is less than one, right?
Yes.
So then definitely we can take up project three, right? The only option left over.
Yes, right.
This is nothing but the odd man out. So
Mm.
project three is like giving us all these satisfactory returns. It is giving us a positive NPV. It is more than one, and its IRR is more than the cost of capital, right?
So- right.
Hurdle rate. So let's move forward now. Next question. Now this one I expect you to do summary.
Uh, Project 3 and 4.
On okay. So a company is considering four independent investment proposals. Company has $3 million available for investment during the present period. The investment outlay for each project and its projected NPV are given. So this much is required, this much is required. So they have 3 million, right?
Yeah.
This much is required and this much is required. And what are they asking? The NPVs are given. Which of the following project options should be recommended to company management? See, actually there is a limitation, right? They cannot
Yeah.
spend more than $3 million. Am I right or wrong?
Right.
So as I told you, when there is a limitation, when there is a limitation or capital rationing, the best criteria or suitable criteria for deciding the project is nothing but what? Profitability index, right?
Yeah.
So capital rationing exists here when some limitation is there. So in such kind of situations, a firm cannot afford to undertake all the profitable projects. So during capital rationing, since they have a limitation, all the projects cannot be undertaken because they have a limitation, right?
Yes.
Even though they prove to be very profitable. Okay.
Yeah. Okay.
So the PI, profitability index method, is a method for ranking projects to ensure that limited resources are placed with the investments that will earn the highest discounted future cash flow per dollar of investment. That means for one, so if I say, I said 1,20,000 is what I got, and present value of cash inflows, and like 100,000 is what I spent. For $1 spent, I am getting $1.2 or 20 cents extra profit, right? So
Yes, sir.
here for every $1 spent, which is the best investment, I have to check, right? So
Okay.
how to do the profitability index? So I will find out the PI of all these four projects. How to do? See, you already know NPV is present value of cash inflows minus present value of cash outflows, right? That means if
Yes.
your inflows were 5 lakh 40 and your outflow is 5 lakh, then only your NPV would have been how much?
40,000.
So I will take 5 lakh 40 by like 5 lakhs. Okay. You understood, right?
Yes, sir. I understood.
And here it will be 10 lakh 20 by 9 lakhs.
21.
Here it will be 1380 by 12 lakhs. Here it will be 1750 by 16 lakhs. So what is the PI here? What is the, can you tell me the answer?
1.0.
1.080, right?
Yes.
1.133, here 1.150, here 1.094. Now, if I do the ranking, the first rank will go for project number
2.
2 or
3.
3? 3.
3.
So
3.
yeah, so first desirability would be for like 3, right?
Yeah. Right.
So third rank, and then second would go for based upon PI, second
Yes.
one, right? And then like fourth one, and then
One.
first one. Okay, but you have only how much available with you? $3 million. So now based upon this rank, you have to select the projects, right?
Yes.
So in this case, we will definitely go for the 3. So one out of 3 million, 1.2 million is like, spent. Okay.
Okay.
Okay. So 1.2 million is spent. And then how much is left over?
8.
No, this is 1.2 million, right? Yeah. Out of 3 million, if I remove 1.2 million, 1.8 million is left over, right?
Yes.
So altogether, third and fourth. But as per the ranking, yeah, I can, if I have to take up, so I can take, because I cannot take up the fourth one, right? Why I cannot take up the fourth one? Fourth one, if I take up, I am left over with less funds, correct? So see, as per the ranking wise, I can take up this 4 projects. Am I right? But I
Yes.
have only 3 million. So I will
Yeah.
take up the third one. So third
Okay.
one, if I take 12 million, then I can take up the second one. That is 0. That is
9.
0.9 million. It's not 0. No, no, no. 9. 1.2 plus 0.9, sorry. And I can take 0.5, right? That
Yes.
means 1.2 plus 9 is how much?
20, 2.1.
2.1 plus 5 is how much?
2.6.
2.6. So I don't have the scope of taking the fourth one, right? So I
Mm.
can take 1, 2, 3 projects, right?
Okay.
Correct?
Yes, sir. Yes, sir. Right.
If I take 1, 2, 4, then 1 is 5, 2 is 9, 5 plus 9 is,
14.
and then here it is
16.
16. So so it will be absorbing everything, right?
Yeah, 30. All.
So project 4 is desirable. Project 4 is more because the NPV what you are seeing here is more in project 4 than project 1.
Right.
But insufficient funding is available to engage in project 4, right?
Yes, sir.
So then other projects like it is not feasible. 2, 3 and 4. If you take 2 and 3 and 4, it is like going beyond the limits, and 3 and 4 is less, right?
Yes, sir.
So like we can take up the projects, but only where we can easily utilize our funds. So shall we move forward?
Yes, sir.
See, if you shouldn't be like putting the entire money. Some buffer should be there, right? That's what.
Yeah. Okay.
So out of 30, if you entirely put 30, then what are you left over with? Nothing you have. So there, if you
Yes.
put your money, you have some comfortably, you have some funds.
Yeah. Right.
Shall we move forward?
Yes, sir.
So next question you have to do, Samrin, I'm waiting. I'll just scroll down when you ask.
Okay. Sir.
So this is the hurdle rate, and these are the projects you are taking into consideration. These are the investments, cash flows, PI, NPV, IRR, all are given. Which project should Maloney undertake during the upcoming year if it has only this much of funds? This is also a capital rationing project, right? They have limitation.
Yes.
Hello.
Yes.
So taking into consideration, this should never be taken. This project is not feasible because it's giving negative NPV, right? Its PI also is less than 1, and its IRR is also less, not crossing the cost of capital, correct? Hello. Hello.
Yes. Hello.
Yes, Amrin, are you following what I'm saying?
Yes, sir. Yes.
So now coming to picture, as the third project should not be taken, right? So
Yeah.
third project is gone. Only project 2. So how much they have here? They have this much.
Six.
So can you
6
take up
million.
only
Yeah.
project 2?
Only two.
See, only 2 if we are saying this is a capital rationing project, right?
Yeah.
So in case of capital rationing, we always take up PI into picture. So if we rank the projects based upon PI, this is already ignored, right? So the first rank will be going to which one, which gives the best PI, right? So project 1.
Yeah.
Second rank goes for project 2, and third rank goes for project 4. Okay. So this
Yeah.
is giving us positive NPV, but it's project 2 we are considering, right? Second option, yeah. The
Yeah.
NPV is positive, but the profitability index is less than project 1. This gives us
Yeah.
better return for $1 of investment. If I spend $1 here, I get 5 cents extra as a profit. If I spend $1 here, I get 6 cents extra. So which is better?
6 cents.
Yeah.
Project.
So project 2 I will ignore. Projects 1 and 2 if I take up, I have limitation of fund because I have only 6 lakhs, right? How much? I have
6.
6 million. Okay. And here 5.4 and 4.9 is breaching that. It becomes 11 million something. So I
Yeah.
cannot take up these two projects. So only one I can take up, which is very desirable. Why? Because it's giving a very, for $1 of investment is giving me 6 cents. As per the ranking of PI, it is the best one. It is also breaching. It is going beyond the cost of capital, the IRR, and the NPV also is the one
Positive.
which is positive. Yeah, no. Second is highest, but we are capital rationing, right? So we consider PI for the for selection criteria, right? Hello.
Okay. Okay.
Shall we move forward?
Yes.
Next.
Technique used. Profitability index.
Yes. Which one is desirable? Why not NPV?
Here in question, then rank them according to the desirabilities given. So in
Yeah.
profitability,
So for $1 of investment, how many cents I'm earning is important for me. NPV does not tell me that one. It tells me about positive or negative. Does not
okay.
take time value of money. What is this actually? All the PI is also a discounted cash flow method. Next
Okay.
question. So this is what they're saying. Capital budgeting methods are often divided into two classifications: project screening and project ranking. Which one of the following is considered a ranking method rather than screening method? So the options are in front of you. So I think this is the one which is best, right? PI.
Yes, sir.
So
Yes.
this is because we take up the one for $1 of investment, which is giving us the best return is what we are checking. So it is the best method for ranking. Time adjusted return. Do you think this is for screening, not for ranking? Correct.
Yeah. Okay.
This is for
Meaning.
screening purpose. We are studying about the project, and this one NPV for any project, if it is more than 0, you take up that one. So where is the ranking here? This is also a tool of,
Screening.
yeah. Okay. So if an investment of, we only accept the investment of certain standard, that is it should be more than, the NPV should be more than 0, right? That is the
Yeah.
standard we consider. And
Yes.
accounting rate of return we don't take actually. It's a very weak method. Next question again. Yeah, this one you have to answer. We have discussed many of such questions.
Yes.
I'm totally depending on your answer. At the end, we'll discuss.
Can you scroll it down, sir?
Yeah. You solve it, and at the end, we will discuss, right?
Okay. Restrictions. No budget restrictions means here we are not having capital rationing, right?
Hmm. There is no restriction of budget. You can put your money, but still you have
Like
they gave some
yeah.
amount. No, they did
Yeah.
not give.
No, sir.
Yeah. So when there is no capital rationing, PI is not the criteria, correct?
Yes. NPV.
Then NPV. So we will ignore this and we'll take up this. Why? Because all are giving positive NPVs,
Positive
correct?
NPV. Yes. Right.
So we can take up 2, 3, 4. So the question was very clear which projects you have to take, and there is no capital rationing as something they have mentioned. They have no budget restrictions. They are ready to take up any project.
Yeah.
Okay, more one, two, more than one, two projects, three projects, whatever. But they will never take a negative NPV project. I mean, there's no capital rationing. NPV can be the criteria to select the project. So all are giving positive NPVs, all can be selected. Next question.
Yes.
In evaluating independent capital investment projects, that means one project has nothing to do with the another. Okay. The best reason for a firm to accept such projects is an see project 1, 2, 3, 4 we were taking all were independent projects, right?
Yes.
So in evaluating independent capital investment projects, the best reason for a firm to accept such projects would be initial investment greater than the present value of cash inflows. Do you think that is good?
No.
Your initial investment, if it is greater than the project cash inflows, you have a negative NPV, so you cannot
Yes.
take up this one. IRR more than the accounting return. Accounting return has nothing to do with our project's decision making, right?
Yes.
We don't take accounting return into consideration. Accounting return greater than zero.
No.
Again, accounting return is a poor method of evaluating capital projects. Profitability index greater than 100% we can take up this one, right?
Yes, sir.
If the PI is more than 1, the
One.
project is acceptable because you are getting the for $1 of investment you are getting more cents. Next one. Company needs an additional machine which will be say used for next 5 years. At which time the machine will be obsolete, that means after 5 years, and have zero salvage value. Company has two options available: purchase the asset for a list price of or market price of this much for cash. So this is now again we have come into lease versus buy, and
Okay.
you have already done this kind of questions in my videos which I've given, right?
Yes, sir. Yeah.
So or lease the asset requiring 5 annual lease payments of this. So the lease payments are given here with the first payment due immediately. That means they will immediately make the first payment. So here comes the concept of annuity due, right? See, annuity regular is what when you make the payments at the end of the year. Annuity due is something when you make the payments at the beginning of the year.
Okay.
Lease payments include 6% interest, excluding depreciation considerations. The best alternative is to lease or buy. So what we have to do in such kind of questions is if buying is good or leasing is good, we have to decide. Okay. Where we
Okay.
are getting a positive NPV, we have to see. So company, the investment, what they are doing is 300,000, right? Initial investment.
Yes, sir.
Did they give anything about the cash inflows anywhere?
No.
No. See, company needs an additional machine that will be used for the next 5 years, at which time machine will be obsolete and have zero value. Company has two options: purchase the asset for this or lease. So they have given the data about lease only.
Yeah.
So now this here the NPV what we are finding out uh, we are we are kind of like finding we are just trying to find out at the present what is the cost for us because the future cash flows are not given. Am I right?
Yeah. Yes, sir.
The future cash inflows are not given in both the cases to decide about the project based upon the net present value criteria. If you want to find out the net present value, the criteria is in future you should get some cash flows, and those cash inflows you'll discount at some required rate of return. Suppose buy, suppose buy, suppose lease. Here some investment you'll keep, here also some investment you here investments are not there, you'll be making some payments, right? Here
Yeah.
if you do the investment you expect some cash inflows, here also you expect, but such kind of data is not there. So the point here is which of these two options are more costly for us or costing us more at present. If we get that idea we can decide which project to select, right? So now
Right.
if you buy it is costing you this much. Let's see if we lease, it is costing us how much as on today, right?
Okay.
So what we'll do, we will take 68. So lease. So we will take 68,000. Sorry,
Yes, sir.
we will take 68,000 into the present value annuity factor at the rate of 6% for
5 years.
like how we have to see it is like for how many
5.
the payments are made for next 5 years, right? Company
Yeah.
has requiring annual payments with the first payment due immediately. So they're making the payment. So we will take for 4 years. So can you see that? Why 4 years? Because they make the payment on first day. So 1, 2, 3, 4, 5. So first day they make, 1 year is done.
Mm.
Okay. Then second payment here, third here, then fourth here. Right? Right?
Oh, yes, sir.
So they are making the payments on the first day itself. So I will just make a timeline. The timeline will be 0, 1, 2, 3, 4, 5. First payment is made here. So from here to here, 1 year is done, right? Second payment is done here. So here to here, 1 year is done, right? Hello?
Yes. Yes, sir. Hello.
Third year. So third payment, yeah. So 1 year done. Fourth payment, 1 year done. Fifth year, payment. So 1 year. So payment is done here. So 1, 2, 3, 4, 5. But we are taking how many years?
4 years.
Yeah. Can you just tell me the annuity factor?
4.452.
4 point
452.
4.46511 they are giving. See for the 5 years.
4.329.
For 5 years.
Yes, sir.
How come?
4.629.
No, no, 6% we have to take, and that too for 5
6%.
6% for 5 years only we have to take
5 years. Then 3.465.
for
For
6%.
6% for 4 years is
No, no,
3.46.
6% for 5 years. 6% for 5 years. Sorry, 5 years.
6%
The
for five
the
years is
period
for
is it's 5 years only, right?
yeah.
One, two, three, five payments are only happening. Yeah. Even though it's happening at the beginning, it's happening. The five payments are happening. Yeah.
5 years 6% is 4.212.
But here they are saying 4.46511 annuity factor. Present
Six.
value annuity factor.
Yes, sir. And for 5 years, 6% is 4.212 only.
Okay, 2 minutes. Present value annuity table. So 6% to 5 years. How come they are? I think it is at the beginning of the period, right? Present value of annuity. Just a second. Just a second. Huh? Okay. So there is one more table, that is present value of annuity due table. Why we are taking present value of annuity due is the payments are made at the on the first day, right?
Yeah, so being yes.
So present value annuity due factor we will take. So that
Okay.
will be 68,000 into 4.46511. 4651. You can just check the table. Shall I send the link?
Yes, sir.
2 minutes. So while doing the questions, please be very cautious because they may give this kind of critical things. So
Yeah.
students commit mistake. So present value of annuity due table you have to check. Just open that. Is it opening?
Yes. Just
I'm not
no,
able
sir.
to. Okay, I'll give the image 2 minutes. Present value of annuity due table, right?
Yeah.
Okay, I'm sending the screenshot. There is a different formula also for this. Whatever you do the annuity into 1 plus R you have to do. That's it here. We already discussed this one, right?
Yes. Yes, sir.
Yeah,
Was.
whatever you do into 1 plus R, if you do, you get the answer. So what is
Mm.
the answer you're getting for this? 3,03,627.
Yes,
So it
16.
is 3,627 more than this, right?
Yeah. Yes,
So
sir.
this is more costly. So leasing is not good here.
Mm.
So lease the asset for a disadvantage. I don't think there is any advantage. Purchase the asset for this advantage. Can be right, correct?
Yes, sir.
If you buy the asset, you save how much?
3,627.
That's what. So if we buy the asset, the saving, this is the saving we have. So the advantage we calculated, right?
Yes, sir. Right.
Yeah. So we'll move forward. Next question. So you want to note it down?
Yes.
Okay.
Done, sir.
Next project. Merken Industries is contemplating 4 projects. They are considering P, Q, R, and S. The capital cost and estimated after-tax net cash flows of each independent project are listed below. Merkens desired that means the returns what is this? Company has a capital budget of this. So again, limitation question has come. I think almost all the questions are of similar kind. Just one
Mm.
question we got a different one. So idle funds cannot be reinvested at greater than 12%. If it is left over, if they are taking up the project, something is left over, they cannot reinvest at this. So the projects are given to you and all the data is also given to you. If Merkin is able to accept only one project, the company would choose which. So again, the question I'm showing, we can solve. See, one thing, if I have to tell, they are taking considering 4 projects.
Mm.
Capital everything is given. The returns what they want is this, and they have a budget of this. And if if beyond budget things are going, they can select other. They can just invest at 12% returns also, right?
Yeah.
That means what? There is constraint or there is no constraint.
No constant.
Yeah, basically I'm not saying constraint here. Why? Because they have made a budget, but they are also saying that idle funds
Can
cannot
be
be invested. That means cannot be invested in project which is giving less returns, right? Idle funds cannot be reinvested at greater than
12%.
12%. That means they that means there is some flexibility for them to spend, or at the interest of 12%. That means if someone is charging them this much, they will not invest, it seems. One criteria. Or if we take IRR as criteria, then this idle funds cannot be reinvested at greater than 12% is some controversial statement. That means that is the finance cost only I'm saying. Okay.
Okay.
So in this case, PI is what I'm not expecting to be considered. Why? Because idle funds, what should be done with idle funds is what they are comfortable with. So one project which they will reject is the fourth one, the S. Why? Because it is giving negative NPV, right?
Right. Yes.
And then like project Q is what they can definitely select if they are going with NPV because it's giving the highest NPV, right?
Yes, sir. Yeah.
And if at all they want to prefer something else, project
P.
Q is preferable
R.
to R as well
Yeah.
because this is giving more NPV, right?
Yes.
So they are asking what they are asking is any
Only
one
one.
project. Yeah. So Q because it has the highest NPV, I can say, right?
Yes, sir.
Next question. Statement below the best represents the definition of capital rationing is a. I will say
Mhm.
situation where constraint is placed on total size of capital expenditure during the particular period. That means how much they can spend, that much only, that limitation is set, right?
Okay.
See, budget constraint. Why budget constraint? Budgets they are making, but how much they have to spend they are limiting. Understood?
Yes.
So capital rationing puts a constraint on amount of funds used for new capital expenditure, not its depreciation expense. So budget constraint limiting total. How come depreciation expense? Are we limiting depreciation expense under capital rationing? No, only we are limiting the investment amount, right? Hello,
Yes, sir. Hello.
did you understand?
Yes, I got it.
You're not putting a limit to depreciation. Limitation where a company selects projects that will meet the minimum number of cash inflow requirements in a year. Where are we? Are we like worried about cash inflow? No.
No cash flow.
Limitation where a company selects projects that will meet minimum number of. No, we are only thinking about the outflow of funds, not inflow.
Okay.
Policy that helps optimize investment policy by ensuring that no. Why? See, capital rationing only sets a limit on amount of funds invested, does not choose the best projects that meet that limit. So only fourth situation is best.
Mm.
Next one. Did you understand this one, Samri?
Yes, I understood.
Yeah. Did you understand the third statement? Policy that helps optimize investment policy by ensuring that the best mix of products is selected. So capital rationing is setting a limit of funds invested, right? It does not choose the best projects that meet that limit. We
Okay.
are only worried about how much, like some investment we have put a limitation. We don't want to spend more than that, right?
Mm.
Capital rationing is all about that. PI will give you which combination you can take up. Understood?
Hello.
We are only discussing about this word called capital rationing. We are not discussing about selection of projects based upon PI or NPV or what. Only capital rationing meaning they are asking.
Mm.
Best mix you can select, but that is based upon what? PI, right?
Yeah.
Yeah. So the word itself is what they are asking. 13th question. Meloni company uses a hurdle rate of 12% for all capital expenditures and has done the following analysis for 4 projects for the upcoming year. They have given which project would Meloni undertake during the upcoming year if it has only this much of investment funds available. Again, limitation, this thing, right?
12 millions. So, for
This they won't take, right?
yes,
Projects 1 and 3 will they take? They won't take the combination because it has negative NPV. So first option will not be acceptable, right? Hello?
yes, sir.
Are you following?
Yes, sir. Yes.
What about the project 1, 2, and 4?
No, sir.
They have
Here
a limitation, right? It is going beyond that.
it's going down.
1.2 12 million is the project size, right? The
Yeah.
investment they can do. 1 and 2, they are getting positive NPVs and PI also, right?
Yeah.
And if they take up this two, they cannot take up this, right? Hello?
Yes, sir.
Yeah. So with only each project costing this much, okay. So more than two, if they take up this one, they cannot fund.
No.
So they can take this. And what about 1 and 4? See, if at all I take 1 and 4, the NPV of 1 and 2 is more than NPV of 1 and 2 combined is more than NPV of 1 and 4. Am I right? Hello?
Yes, sir.
NPV of 1 and 2 combined is more than NPV of 1 and 4. So I will not go for this 1 and 4 option, right?
Right, right.
The best one is 1 and 2. Next.
Um,
You're following something, right? Somewhere
Yes,
lost?
sir.
Okay,
No,
okay.
sir. No. Just calculating the investment amounts to
Okay,
tally
okay.
those.
No problem, no problem.
It's
Company has a maximum of this much available for investments. Company has identified the following investment options. So they have 5 million. They have this projects. Which one of the following alternatives should be recommended to management? Again, they have a limitation and which one they should select. So you should be answering this. So you'll be answering this based upon which method.
PI.
So you can do this. Just try this. I'm coming somewhere in 2 minutes.
Okay, sir.
Yeah.
Sure, sure. Yes.
Auntie, auntie.
Yeah, Samrin, what's the answer?
Yes, doing this.
You're doing that, right?
Yes.
Okay, okay.
Hello.
Yeah, so the profitability indexes, I'll write it here. It's
Yeah.
1.20, right?
Yes.
So, like, what have you done in this profitability index? How did you find out?
By NPV by calculating cash discounted cash flow minus investment. I did so to get
Discounted
NPV.
cash flow by initial investment, right? So 336 by 280. You got 1.20,
Yes.
1.15, 1.14, 1.14, 1.25, right?
Yes, sir.
So accordingly, which projects you'll be taking up?
1 and 2.
1 and 2. You can invest how much? 5
5.
million.
five
If you
million.
take 1 and 2, so I think this is 2.8 million and this is what? So you're still left over with funds, right?
Yes.
So let's take like 2, 3
That
and 4. If you are considering 2, 3 and 4, what is the case? So can you
Left with
take up
one,
the
1 lakh.
combination of is not most profitable use? Why? Because you have investment constraint, right? So if you take this one 2.3, 1.2, and 2, 3, and 4, 1.5. What is happening? 5, 6, 7, 8, 9, 10. You are left over with what? Nothing, right?
No, yes.
You won't be taking up.
145.
And here the total NPV would be how much? 2, 3, 4, 5.7 something you'll get total NPV. Okay.
Okay.
Combined. 1, 4 and 5. 1.20,
Left with
1.14. Yeah. So what is happening? 2.8 and 1.2
8,
and 0.8.
4.8.
Yeah. So we are left over with something, right?
Yes.
And the combined NPV here is 5.705. And the combined, so I'll write combined NPV 5.705. That means for 1, 2, 3, and 4, the combined NPV is this. And the combined NPV for this is nothing but 5.728. This is more than this, correct or wrong?
Yes.
Right?
Right, sir. Correct.
And if I take up 2, 3, and 5, so 1.5, 2.3, 0.8,
4.6.
4.6. And if I take the combined NPV for this, the combined NPV is 5.3, less than the B, correct?
Yes. Yes.
So not that good. 1 and 2, 1 and 2 if I take, I am left over with lot of funds, but the combined NPV would be 5.0, not that feasible, right?
Yes.
Okay.
Yes, sir. B is correct one.
So the investment constant is 5.0 million, but what we are getting is the maximum here. Now, 15th question.
In intelligence.
Entity has completed capital budgeting analysis on 4 projects below. The entity has this much available to invest in 3 mutually exclusive projects. That means you can select only one.
Mm,
Okay.
okay. So we have to find NPV or directly we can using profitability index. Okay.
They're asking PI. So you can just find out the PI, right?
Yes.
The PI for the first one is 1.062. If you calculate, that is 85,000 by 80.
Yeah. 0.914.
So you can see which project is the best one, which is giving the highest PI.
Project 4.
That's it, done. Shall we move forward?
Yes, sir.
16th one.
So now
Which one of the following capital budgeting techniques would result in the same project selection as the NPV method?
profitability index.
Index, yeah. Next, 17. An entity is evaluating two mutually exclusive projects. That means only you can take. One requires this much, another requires this much. The finance department has performed an extensive analysis of the project. The CFO has indicated that there is no capital rationing in effect. Which of the following statements are correct? So both projects should be rejected if the payback periods are longer than the company standard. Project with highest IRR should be selected. Project with highest NPV should be selected. Select the project with smaller initial investment regardless of which evaluation method is used. So if I take 1, 2 and 3, let's say 1, 2 and 3, both projects should be rejected if payback periods are longer than the company standard. So here for mutually exclusive projects, we won't be considering much often the IRR method as the criterion, right?
Yeah.
So project with highest IRR should be selected, assuming that both IRRs exceed the hurdle rate. This can be a better thing.
Yes.
See, the lower priced project may have higher IRR but produce less cash flow than the higher cost project. That is the problem. See, the lower cost project may have a higher IRR. Okay, because both are exceeding hurdle rate, right? But the cash inflows will be less in this case, correct?
Yeah.
So what the thing is, this will produce less cash inflow and the cost seem to be very high, correct?
Yes.
Correct. So
Yes.
what about the second one? So one like 1, 2 and 3. So the second one is not suiting the criteria. So equivalently, this if second is not suiting, we won't go for this. What about the 1, 2 and 4? Again, the second one is giving a issue, right?
Yes.
See, the size of the initial investment considered in isolation is not a sound criterion for evaluating capital projects. What about 2 and 3? Again, the same thing. 2 is there. What about the 1 and 3? The 2 is not there, correct?
Yes. Yes.
So, yeah,
Yes.
so if we take up the payback criterion, both projects should be rejected if their payback are longer than company standard, correct?
Yeah. Right.
So in case of payback, both should be rejected because they are taking much time to like break even or recover the investment. And secondly, projects are mutually exclusive, so only one should be selected. Am I right?
Yes, sir.
So selecting the project with higher NPV is a better criterion.
Yes.
So 1 and 3 goes well. So 1 and 3 are the exact reasons what we can see.
Second, point number 2, can you explain again, sir?
Yeah. Highest NPV project, only one out of all should be selected because it's in mutually exclusive projects case. Yeah. What are you saying? Second one. See, project with highest IRR should be selected. They are saying, right?
Yeah.
See, so project with highest IRR should be selected. See, the project. So in this case, there are two investments, 4 million and 6 million, right? 4 million and 6 million are the investments, right?
Yes, sir. Yes.
So in this case, the cost is less. In this case, the cost is more. This may have a higher IRR than the cost of capital, correct? But it may give us low cash flow, less cash flow, correct?
Yes.
So in case of this, the NPV will be less. In this case, the NPV will be more. So if I have to give you a final answer for mutually exclusive projects where you have to select only one out of every other projects, NPV criterion is the best suited one and the highest NPV should only be selected. Understood?
Yes, sir.
In this case, in this case, cost is less. Maybe the cash inflows will also be less, right?
Yeah.
So the cost will be more and the cash inflows will be less. So here, here like the investment is 6 million and like this is a lower investment, so lower cash flows, higher investment, higher cash flows, right?
Yes.
So even though the IRR is more than the cost of capital in both the cases, the cash flows will be less, will give us less NPV. Cash flows will be more, give us higher NPV. So this is the better one, right?
Yes.
Next one. Manufacturer is considering two independent projects, Q, R and S, each requiring cash outlay of this much and having expected life of 10 years. Forecasted annual cash inflows for each project and the probability distributions for each for these cash flows are as follows. So they have given probabilities, right?
Mm.
So the probability is this and the cash inflow is going to be this. Okay. So what is the probable outcome here? Probable outcome is probability into cash inflow, right?
500. Yeah.
80%.
76.
So here it was like 100%. That means like I'm putting into percentage. So 10%, 80%, 10%. Okay, this how much is the total? 95,000, right?
Yes.
And here the probable, why I'm finding out probable outcome, because there's a probability assigned to the cash flows.
Okay.
So probability into cash inflows will give us the how much cash we are going to receive, right?
17,500. 55,000.
In probabilistic approach, you have to multiply with the cash flows with the probability, so you'll come to know how much cash you're going to get. 70,000 is what you're expecting, and the
Okay.
chances that you will be getting 25% of that is nothing but how
Mm.
much? 17,500, right?
Yes.
This much you're like having a anticipation.
1,10,000.
So what are they asking here? Should we accept both projects or reject?
Accept both.
Why?
Both have positive cash flows.
Yeah, see, both are giving us the probabilities assigned are something like we are getting cash flows in both the cases. So project R is less risky, right, than project S, correct?
Yes.
As the anticipated cash flows are more certain here, the anticipated cash flows are more certain, right?
Okay.
Both in, because see, 50, this is also 100%. So project, because here we are 80% confident, the confidence is very high here, here 50, 50, 50, 75, 50, 25, 25. So here the probabilities are less certain, here the probabilities are very firm, right? In this
Yes.
second case.
Yeah.
And since here the risk is, where the risk is more?
Yeah. Project R.
R. So when risk is more, when risk is less here, it should be discounted at 12%, right? And when risk is more, it should be discounted at
18.
16%.
16%.
Manufacturer has decided that the project with greatest relative risk should be having a hurdle rate this, and less risk will be having a hurdle rate of 12%, correct? So more risky the higher hurdle rate. Less risky, the lower hurdle rate. Correct? You'll be discounting.
More risky one is project S.
Yeah.
Okay, more cash flow. Okay.
No, see, it's not like that.
Mm.
The distribution is here 80% more certainty, right?
Yes.
And like here the certainties are less, right? 50% less certainty,
Yes.
right? 50% is
Yes.
less than 80, and the project R is less risky. Why project R is less risky? Because the cash inflows here, like what we are seeing, are more in 2 years, less here. Here the cash inflows are more, right?
Yes. Yes.
Here the certainty of the cash inflows is more. That means we are like 80% is a very higher probability what we have assigned here. So here seems more certainty, correct?
Yes.
Here seems
Oh,
less certainty. So
got
this is less risky, this is more risky. Less risky with a hurdle rate of 12%, more risky with a hurdle rate of 16%,
it. Okay.
right? Why
Yes.
here the certainty is more? Because 80% we are certain in one of the cases. Here the certainty is like less. Yeah, I understand in two of the cases the certainties are very less, but altogether if we see, the weightage is more here, right?
Yes. Right.
Now, so did you calculations you did on like 25%, right? 70,000, you got 17,500, correct? Project S.
Yes.
Yeah.
Right.
So now the point here is project R should be discounted with 12%, S with 16. Discounting the cash flows from project R. So we are getting 95,000, right? Project R. And what is the time they have given, time limit?
10
10
years.
years. So 95,000 will be getting every year, right? So 95,000 into present value annuity factor at the rate of 12% for 10 years. You understood now?
Yes.
And then 1,10,000 into present value annuity factor at the rate of 16% for 10 years. Why we are taking present value annuity factor? Because every year we are going to get this cash flows from project R, and every year we are going to get the cash flows of this one from project S, correct?
Yes. Sir.
So
What
now how much it is then?
5.650.
Yeah, 5.650. Can you just multiply and tell? And this one?
4.833.
Tell me the values.
5,36,750. 4. 5,31,630.
Okay. So both are giving positive NPVs, right? Both are beyond 5 lakhs, right? Hello.
Yes.
What was your initial
Hello.
investment? 5 lakhs in both the cases, right?
Yes.
So are they giving negative or positive NPVs?
Positive.
That's it. So if they're giving positive NPVs, accept. So very simple. We are investing this much. We found out the probabilistic cash flows. The only criteria to put the discount rate was less risky, more risky. This is more risky, less risky. So less risk because more certain cash flows, less certain cash flows. We put the discount factors, found out the NPVs, and we checked that it is positive. So we accepted both the projects, right?
Yes. I got it.
Let's go for the next question.
Yield index.
Just too short of finishing today's session.
Okay.
Yeah. So you have to just do the PI thing. So you know this is NPV, right? So you know like the cash inflows will be. You have to find out the present value of cash inflows in all the cases.
Yes.
So if I take up project B, NPV they have given 7 lakhs. That means 77 lakhs, right?
Mm.
Cash inflow minus investment is equal to NPV. Investment is 70 lakhs, right? Cash
Yes.
inflow I'm supposed to find. So NPV is 7 lakhs. So cash inflow will be 77 lakhs. So
Yeah.
77 by 70. I'm getting how much? 1.10. Correct?
Yeah.
So
1.2.
project A. Again, investment is this. Cash inflow you are supposed to find. So you have, so one thing you can understand, cash inflow is equal to NPV plus investment, right? You add these two.
Yeah.
If you add that, how much you're getting?
Answer is 1.11 I'm getting.
Yeah, 1.11. Next one.
Project D.
So 53 lakhs by 50, right?
Mm.
And then next one is 22.5 by 20. What is the PI?
1.06.
This one.
Mm.
How come?
53 divided by 50.
Just a second.
3.
Yeah, 53 lakhs divided by 50. And next one.
0.9.
Okay. So now the best investment, what you are going to pick up is what?
Project A.
Project A, right?
Yes.
Just a second. I think project A is the best, yeah. But they are asking based upon this only, right? So project A. Okay, done. Shall we
Yes.
move forward?
Yes.
They are giving a wrong answer. That's what I'm saying. Last question. Uh, which project should Melanie undertake during the upcoming year, assuming it has no budget restrictions? So no budget restrictions is what? IRR, right?
Yeah.
So they
1,
should.
2, 4.
Yeah, I think this is a repeated question again. 1, 2, 4. Correct?
Yes.
It's a repeated one only. We have already done. Okay, Samrin, then done with this, the rest of the questions you need to solve. They were
Oh,
40, so 20 are done. 39, 20 are done. Okay.
okay. Sir.
So the next one we are going to take up, I see if I have time in the afternoon. Okay, I can't commit. If I
Okay.
have time, I will try to take up So this is done.
Mm.
Done. 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 We have to do some 40 questions. The task is big here. Okay, uphill task. So tomorrow, day after tomorrow, if I sit, I can finish this.
Okay, yes.
As I have holiday tomorrow and day after tomorrow, both the days. I'll see if I have time, I'll inform you. Otherwise, we will take tomorrow only. Okay.
Okay.
If we take 2 days, it will be done like 20 questions. That can be done. And comprehensive examples, we will see what that is. If it's combination, then you can solve them.
Yeah.
Okay.
Okay. Okay.
Okay, something. Thank you.
Thank you.
Thank you.